Welcome to the second video about emerging markets, and in this video we are going to discuss the main benefits of them. Now, understanding these benefits is essential because emerging markets can be your most profitable investment, so please pay attention. Now, the benefits of emerging markets are that they have higher economic growth potential than developed markets. Also, emerging markets have a lower correlation with developed markets, and emerging markets have higher historical returns than any other asset. So let's just start with the first benefit, and that is that emerging markets have higher economic growth potential than developed markets. Now, what you can see in this graph is the GDP growth of the BRIC countries compared to the United States and Germany. Now, GDP stands for Gross Domestic Product, which is a measurement of the growth of an economy. And what we immediately see is how the GDP growth of the developed countries, the United States and Germany, is consistently lower than that of BRIC countries, with China and India as absolute outperformers. Now, this is because emerging markets, because of their developing nature, usually enjoy higher growth rates than developed markets because they catch up with mature markets. So for this reason, investing in emerging markets can become very, very profitable. Now let's look at some of the background reasons on why emerging markets are growing so fast and why they're actually catching up with mature markets. Now, one of the drivers behind this growth is that there is a heavy increase in domestic consumption because of income growth and urbanization. Now, companies in emerging markets can take advantage of these trends, and they actually do take advantage of these trends. There's also an increase in exports, and there's improving infrastructure and technology. Now, developed countries already have a good infrastructure and a high level of technology, so that is why their economy is growing less than emerging markets. Now, another driver behind this growth is the young working age population. Now, countries with younger populations tend to grow faster because there will be more consumers, but also more employees being able to produce more. So now we move on to the second benefit, and this is that emerging markets are less correlated with developed markets. Now, correlation indicates to which degree assets move in the same direction. Now, we already discussed correlation at the beginning of this course, but we will go over it briefly one more time. Now, if you add different assets with a low correlation, they tend to be relatively independent of each other. So that means that one asset could be down and the other could be up. So one could be losing your money and the other could be making you a large profit. Now, if you have assets with a high correlation, that means that those assets move in sync. They move in the same way. So that means that if asset A is down, it is very, very likely that asset B will also be down. Now, in order to have a well-balanced portfolio, it is important to include low correlated assets. And here you see an example of the benefit of diversification with a lower correlated asset in my own portfolio. Here you can see that emerging markets earn me 11% or almost 11% in the same time period that European large cap stocks earn me not even 2% and US large cap stocks not even 4%. So this shows us that emerging markets have the potential for very high returns and that they are not heavily correlated with developed markets. As you can see, they earn me a lot more than the developed markets in the same time period. Now, during the past decade, emerging market stocks and US stocks have had a correlation of 0.79. So by comparison, US stocks and those from other developed nations have had a correlation of 0.89 during the same time frame. So this means that by adding emerging markets to your portfolio, assets from the United States can be down, while the assets from the emerging markets can be up. And you saw in my own portfolio, in the example from my own portfolio, that emerging markets earn me a much higher profit than European and US large cap stocks in the same period. So that is an example of assets that are not heavily correlated. Now, it must be noted that this correlation has been increasing over the past 2 decades because of factors like globalization. But for now, we can say that emerging markets still have the benefit of having a lower correlation. Now, the third benefit of emerging markets are their extremely high historical returns. If you would have invested $10,000 in emerging markets in 1972, you would have had 4.8 million in 2014, and that is some serious money. Now, in contrast, if you would invest that $10,000 in the total US market index, you would have had not more than $1 million. And of course, this is still significant, but it's a difference of almost $4 million. So that's really a reason why you should consider investing in emerging markets. Now, of course, these results are historical and they provide no guarantee for future results. However, they do provide an indication since we are talking about a large group of stocks and not just one single company. It is always easier to predict what assets will do in a large group compared to what one single asset will do in the future. Now, these advantages are huge factors to include emerging markets in your portfolio, but unfortunately this comes at a price. And this is something we will discuss in the next video.